Hello and welcome to Portfolio Matters Week 94 Weekly Update. Before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Thank you, Richard. Well, we've got a packed week this week because we had the UK autumn statement, and we will go through the implications of that. Now, other news was this week, the UN estimates that the global population passed 8 billion, and it passed 5 billion in 1987. So, the world is supporting an ever-increasing number of people, although it is now forecast to peak at 10 billion. So last week, the Ukraine reclaimed Kherson from the Russians, who withdrew. So the war there continues. In China, we've had a big surge in Chinese property company share prices as China has announced various stimulus packages to try and revive the Chinese property market. We'll go into that. And finally, Germany has commissioned its first floating LNG regasification terminal, which they built in a record 194 days. So the European energy crisis is currently going well. We have our usual section on that. Okay, some charts relating to the news. Well, the blue line, is the number of people in the world, which estimated to have crossed 8 billion this week, and forecasting that it will peak at around 10. You'll see the growth rate is declining, but declining growth rate on a very large number still means big growth in people. And last week, after the weak CPI print, the US Fed funds rate, the forecasts are for it to peak at a lower level than it was. So interest rate expectations are coming down. Now, in China, we're having a surge in COVID cases. So whether they will be opening up anytime soon as we go into winter is open to question. And the FTX token, FTX, has blown up in spectacular fashion. And we've seen big withdrawals from Bitcoin this week and Tether. And talking about the war in Ukraine, this is the current status as reported by the UK Ministry of Defense. And fighting is ongoing in the east. Although in the south, close to Kherson, we now have a river separating the Russians from the Ukrainians. Okay, on to this week's economic data. And there's a lot of it, I'm afraid. We've had a big data dump, so I'm going to go through a lot of this. So in the UK, we had September GDP numbers, and that missed expectations. It showed the UK economy contracted by 0.6% in September. And so the UK economy may already be in recession. The year-on-year number also missed expectations, but showed the UK economy grew by 1.3% in the year to September. UK manufacturing production also missed expectations, expected at minus 4.2% in September, it came in at minus 5.8. Construction activity, weirdly, beat expectations, and although it slowed from August, it was still a very healthy plus 5.7% year on year. The UK trade balance has improved and was only minus 3.1 billion in September. We'll show you a chart in due course. We also had UK inflation expectations. Now, the main CPI number rose from 10.1% in September to 11.1% in October, and that slightly beat expectations. The core CPI number missed expectations and was flat on September. So core seems to be stabilizing, CPI still rising and just beat expectations. RPI beat expectations and rose to 14.2%. Remember, RPI is how we used to measure inflation. We also had European inflation numbers, and they also rose. So in October, European CPI was 10.6%, well up on September, although slightly missing expectations. Core CPI was 5%, again up on September, but hit expectations. However, the Eurozone economy remains surprisingly resilient. In September, industrial production was 4.9% year on year, beating expectations by a decent margin. And if we look at the ZEW Economic Sentiment Index for November, you see it massively beat expectations. In October, it was minus 59.7, and it recovered strongly to minus 38.7. So still terrible, but much better than expected. And then we had a load of US data as well this week. So we had the US Michigan surveys of US consumers, and they were generally poor. So the sentiment index itself for November declined from 59.9 to 54.7, which is bad. But at the same time, inflation expectations worsened. So previously, inflation expectations had been coming down. In November, they rose again. So 1 year inflation expectations rose to 5.1%, 5 year to 3%, both well above the Fed's 2% target. We also had PPI numbers, and they added to a picture of October US inflation that was below expectations. So PPI came in at 8%, which was down on September and below expectations. Core PPI came in at 6.7%, down on September and below expectations. However, the US housing market is defying gravity. Housing starts beat expectations. They were lower than September in October, but still very healthy at 1.425 million annualized. And building permits also beat expectations, although again, they were down on September. And finally, on to China. Industrial production there missed expectations in October and was down on September, and retail sales were awful. In October, they were contracting at minus 0.5% annualized, massively down on September and missing expectations. We also had some quarterly numbers. So UK GDP growth in Q3 was 2.4% year on year. Quarter on quarter, though, it was minus 0.2%. So the UK economy is currently contracting. Business investment was poor, down 0.5% in Q3, although construction orders, weirdly, were up 8.5%. The EU economy is doing much better than the UK. So in Q3, quarter on quarter, it was up 0.2%, although year on year, it was up 2.1%, which was lower than the UK. Right, some charts. Richard.
Thanks, Keith. The most depressing one of the day possibly is the UK CPI. There's UK core CPI, which we don't experience, we're just told. UK RPI, that's pretty depressing as well, actually. Maybe that's more depressing.
Yeah.
That's 1970s style RPI, which is very, very unpleasant. And UK GDP growth month on month, looking sick. And year on year, the trend is not happy. Manufacturing production year on year, that's just really unpleasant for the economy. UK construction output, I would expect this to start falling away fairly soon, actually. I think given the rest of the economic malaise, this is unsustainable.
I agree with you.
And UK construction orders still positive. UK trade balance, as Keith said, is actually improving. And the UK unemployment rate is just slightly sort of showing an upward trend. EU CPI, I mean, it just looks just as bad as the UK CPI year-on-year chart. And the core CPI, which none of them experience either, is looking very unhealthy. EU industrial production, yeah, surprising increase there, given the energy costs that they're experiencing. And EU GDP growth does look like it's heading towards recession, as is technically defined. Here's a question: do they measure GDP growth against core CPI or CPI?
CPI.
What about RPI? Not RPI then.
No, RPI.
RPI is UK.
Only the UK uses RPI, and is now a defunct measure
because it was showing inflation as being too high, wasn't it?
Exactly. Yeah.
It includes interest rates, RPI, as it should do.
Well, the thing about RPI is RPI uses an arithmetic mean, and CPI uses a geometric mean. And CPI essentially assumes that consumers will switch to cheaper goods in order to maintain their lifestyle. So if there's higher inflation in carrots, people will switch to broccoli. So
no account of quality.
Yeah, essentially. So if you try and maintain your personal preference basket, your RPI is the more appropriate measure.
Yeah. It's all smoke and mirrors to enable governments to print money.
Yes.
EU GDP growth year on year is looking reasonably decent level of growth, actually.
Yeah, but these are year-on-year numbers, and a lot of the growth is because earlier in the year you can see how they're doing quite well. More recently,
very tricky. EU balance of trade, presumably that's a lot of that is associated with fuel, energy costs, imports.
Although you notice that it was already negative even before the war in Ukraine.
Yeah, yes, it was. Quite sharply so. EU economic sentiment index, pretty low, really. I expect that will turn down.
Yeah.
Mr. Doom and Gloom. So the US Michigan Consumer Sentiment Index, where 100 is neutral, is looking pretty sick, and the downtrend is still ongoing. And the current conditions index is looking the same, as is the Consumer Expectations Index. And the one-year inflation expectations actually have jumped back up again, and people are expecting inflation to persist for longer. 5-year expectation is also rising again, and I think they're right. And the US Empire State Manufacturing new orders is quite a scary chart, actually. The rapidity with which that has fallen away is extraordinary, and it's now back at the 2009 levels, and heading down fast. Interest rates rising.
Yeah, the thing is, Richard, everyone is forecasting a mild recession. If you look at some of this data, it's nasty.
US PPI falling down, continuing its descent as its core PPI.
So if the usual relationships hold, that should mean CPI also peaks and comes down in due course.
And the US 30-year mortgage rate is still very high at 7-point-something%. Relatively high, I should say. US housing starts still looking actually very healthy.
Yeah, amazing, absolutely amazing, given the very high mortgage rates.
But US housing prices,
Mm,
so there's building permits again. Builders are still gung ho.
yeah, because I suppose the thing you would say is that although house prices are coming off, they are still very high.
Yeah.
And if you can sell houses at these prices, you you will do. The trouble is that buyers are stepping back from the market.
At the moment, it's the rate of growth that has fallen to zero, as opposed to the actual prices starting to fall. Continuing jobless claims, so there's a beginning of an uptrend there, I would say. This is weekly data. China industrial production, well, stick a finger in the air. Retail sales, likewise, stick a finger in the air. Chinese fixed asset investments year on year. So the UK economy shrank in September, maybe in recession. I mean, just on that, we have got higher and increasing interest rates. We've got higher tax rates. We've got reduction in disposable income through inflation. And we have a government cutting back on public expenditure, which is all of those things are going to drive the UK into a deep recession, in my view. And in some senses, we're paying for the pandemic and the 2 unnecessary lockdowns that we had.
Mm-hmm.
And in some senses, we're paying for the triple lock. And I would say we're paying for the incompetent management by the Conservative government for the last 12 years. And probably prior to that for other governments. Both EU and UK inflation continue to rise, maybe approach peak. But I would say that one of the things we have discussed in these podcasts previously is that inflation, historically, when you have higher inflation, it comes and goes in waves. And just because it's falling down now doesn't mean there won't be another wave. And then and those waves are quite long in terms of duration. US PPI and core PPI both lower than expected. And US Michigan Consumer Survey showing that consumers are pretty pessimistic.
Thank you, Richard. On to one chart. And going back to Richard's point about how we're suffering from previous government mistakes. So this is the Fed's projections of its own federal funds rate at different points in time. So the blue lines are the Fed dot plot, and the red line is inflation. And you'll see that starting in March 2021, inflation really began to pick up. But the Fed at that point had stated through forward guidance that rates were going to be lower for longer, and they were committed not to raising them. So even as inflation hit 5% by June 2021, the Fed kept rates essentially at zero, and they persisted even as inflation rose to the best part of 6.5% by Q3 2021. So the reason we're in such a fix now is the Fed was way too slow in raising interest rates, and now it's having to raise interest rates much faster than it otherwise would because it remains behind the curve. So in summary, forward guidance was an absolutely disastrous policy that locked the Fed into keeping interest rates close to zero, even while inflation surged.
I could just chip in there, please, Keith. I'd just like to comment that I think central banks engaged in a process of overt manipulation, and forward guidance was simply overt manipulation, and they're patting themselves on the back as how clever they were. And actually, it's much better to be very straightforward with these things, tell the truth, be honest, and deal a fair hand. And they have developed this concept that they are capable of controlling anything they want to by snapping their fingers. And it's very foolish. And I think the chickens are slowly coming home to roost.
Yeah. Well, in the case of forward guidance, I think they were too much guided by the past and the low inflation of the previous decade. And I mean, when we started this podcast, we were talking about how massive fiscal stimulus and low interest rates absolutely could get inflation rising again. And they didn't believe that.
No.
And then when inflation was surging, we had the whole idiotic transitory argument that inflation was just going to be a wave and it'd pass through. And, we discussed at the time how using the word transitory was itself manipulative and clearly wrong.
Yeah.
And, we are in this mess because of the central banks.
They lock themselves into a verbal cage.
Yeah. Bottom line is the Fed is now behind the curve because of its own mistakes. And when we say Fed, we mean central banks of the world, essentially. Okay, on to inflation watch, Richard.
Thank you, Keith. As if we haven't had enough of inflation already.
Yeah.
Okay, so all I suggest is rather than reading through the numbers, if you're interested in this data, take a look. But effectively, most of the European and UK inflation rates are continuing to increase. The US is falling at the moment. And this is a chart that shows where the greatest amount of inflation is. And clearly airfare, this is in the US, airfares are going up dramatically. There's a lot of energy inflation. And at the bottom end, car prices are dropping, used car prices are dropping. And the car rentals seems to be following that. IT hardware and services, so we know that the US tech sector is in significant trouble at the moment, generally, and presumably that is a reflection of the trouble the tech sector is finding itself into. And there in yellow, we have overall inflation at 7.7%. So as long as you basically spend your money on the bottom half of that chart, you're not too bad. If you spend a lot on the top half of that chart, like food, for example, or household energy, or housing even, then you're in trouble.
Mm.
And US real wages falling at a record pace. So yes, there is no wage price spiral yet. And exactly the same problem that we have in the UK, forcing discretionary expenditure down. Oh, well, we've seen this chart so many times. We can draw it ourselves. In fact, why don't we draw next month's now, Keith?
Well, this is Wall Street analysts. So, I mean, the chart is the same, whichever forecast do you use. But, Wall Street banks, terrible as well.
They've used probably about 130 degrees rather than 90 degrees for their charts, but
yeah,
they must goal seek their spreadsheets, mustn't they? That's the only way you can get that level of consistency is by goal seeking it.
Well, or just they're all conditioned by history. None of them are thinking independently. There's a huge group think amongst all economists.
And also, if they themselves are outliers, then they get ostracized by their own small community. We need an anti-group think czar, Keith. Or maybe two of us. I mean,
well, I think that's us too, isn't it?
Wage growth tracker, Atlantic Fed wage tracker ticked up slightly. So we don't have a wage price spiral yet, but if this chart line starts to move up, then the US could be moving into a wage price spiral. And I suspect the UK is not far off being in a wage price spiral now.
Well, we'll see. We'll see what the winter brings and the wave of strikes.
Well, and also unemployment rates, Keith, isn't it? That's crucial to controlling that event.
Well, the thing is, unemployment in the UK is definitely ticking up.
Yeah.
And we've seen just the start of that in the US.
Yeah. So this is rates people pay on their credit cards. 16.27%. Notice how when interest rates were astonishingly low, you were still paying 12% on your credit card.
Yeah.
Usury, I think, is the word I'm looking for. Chinese factory PPI is now negative, i.e. the cost of inputs for Chinese factories is falling year on year.
Yeah. So global goods inflation, I think, is firmly declining.
Yeah. Historically, inflation does not tend to fall until after a recession has started. So,
and then unemployment rises relentlessly for 18 months.
Yeah. So Europe and UK inflation rose, as we know, in October, but we don't really know whether it's peaking or in the UK. I mean, it's very difficult to say, isn't it? Very difficult to say. And yeah, in the US, fuel and airfare is the biggest contributor year on year, which I would say fuel and airfare is probably a highly discretionary area. So those price increases, you'd expect to see some form of fall off in demand coming.
Yes, very good point, Richard. Okay, thank you, Richard. Well, the big question is, has inflation peaked? I saw this earlier in the week on Twitter, and it was essentially saying that a large component of the fall in US CPI in October was a one-off adjustment to health insurance. Now, they adjust the CPI components of health insurance on an irregular basis, and it's subject to these big one-off jumps, as you can see. However, it's tiny. The impact is 5 basis points, so forget about it. But US consumer inflation expectations are rising again, as we previously reported, although US consumer inflation expectations are very dependent on the prices of goods that they are regularly exposed to, such as gasoline and food. And if you look at the chart's top left, you'll see that the prices of gasoline and food have both had a bounce recently. So inflation in gas and food is rising again, leading to elevated consumer inflation expectations. If you look at the other components of inflation, they are subsiding. So hopefully, as food and gasoline prices stabilize, then consumer inflation expectations will also stabilize and start to come down. And this is the UN Food and Agricultural Organization's food price index, and you'll see it's declining. And the black line here is the global credit impulse, and you'll see that there has historically been a good correlation between the credit impulse and both CPI and the S&P 500. And as central banks around the world tighten, we're having a sharp decline in the credit impulse, and CPI and the S&P should both follow with a lag.
Could you just pop back to that graph for a second, Keith? An observation, which is one of the things we often talk about, is that the economy is a complex system, and it's not a simple if X then Y system. And one of the things you can see here is that there is a correlation. It's not a huge correlation, but there's a correlation when inflation is between 0 and 3%. That's obvious, some 7 years or whatever. But the question you have to ask is, does this correlation actually break down or become weaker, or even become stronger at higher inflation rates? In other words, things have changed so much that we may be moving into a non-linear process. That's what I'm really saying is, I think when we see data moving outside of these ranges, we need to be careful that we don't simply assume the correlation persists. Yeah. Because the system is much more complex than a simple linear relationship. Now, it may do, but it may not, and it may vary in a way that we is unpredictable. Yeah, no, I agree with that. So market expectations are that US interest rates will actually be lower in 18 months' time than they are today. So the market is expecting inflation and interest rates to peak. US rents have peaked, and the annual increase in rents is now at 5.8%, well down on its peak rate of 18% earlier in 2021. And advertised rents have fallen even further and are approaching zero. Although something we've covered many times is that the US CPI component for rent is a weird and lagging indicator and won't reflect this
for many months and is likely to actually continue rising. And US PMIs are falling, and that should mean lower inflation. And Goldman Sachs are forecasting, we love these, they're all the same. So Goldman Sachs are forecasting that US inflation is going to fall back, but not hit 2%. Morgan Stanley, however, are forecasting that it will, that actually it'll fall very sharply. Bank of America are forecasting that service inflation will be persistent, and like Goldman Sachs are forecasting it won't go back to 2%. So this is the yield curve in the US, and the red line is before the inflation numbers earlier this month, and the black line is on the 14th after it, and you'll see the whole of the yield curve has shifted down. So the market is now anticipating that interest rates will not rise as far and will come down faster. And interest rates around the world for mid-2023 appear to have stabilized. In the case of the UK, they've actually come down, thankfully, after the ructions of the mini budget. So in summary, we know that US CPI definitely peaked back in June at 9.1% and is well down from there. Core CPI is in the process of peaking, but 1 month's data do not decisively mark a peak. Remember that US interest rates are rising, and all the expectations are that they will rise from the current 3.75 to 4% range to over 5%. So there's still a lot of tightening to come, and they won't start falling until mid-2023 at the earliest. So inflation is peaking, but it's too early to say it's peaked decisively.
So, lessons from history for inflation. So the US Federal Reserve Bank's expectations for the speedy reversion to 2% does seem very optimistic. And whilst inflation jumped to 4%, often temporary, when it crosses 8%, it proceeds to higher levels over 70% of the time. And for those of you who are interested, there's a paper written by research affiliates that you can download. It's free. You just Google it. And they've done a great deal of analytical work into past inflations to see what the tendency is in terms of the reversion from a high level of inflation. So they found that if inflation is cresting, levels of 4 or 6% revert by half, i.e. to about 2 or 3% in about a year. And if inflation is accelerating, 6% inflation reverts to 3% in about a period of 7 years, which is threatening an extended period of high inflation. Now, if you look back a few months ago, inflation was accelerating at 6%. And that would suggest that the median time to revert to 3% is going to be a substantial period of time on average. And assuming that 3% is the upper bound for benign sustained inflation, getting there is easy from 4%, hard from 6%, and very hard from 8% or more. And above 8%, it takes somewhere between 6 to 20 years, with a median of over 10 years. In other words, if they are correct in their analysis on this occasion, one would not expect inflation to revert to 3% for many years.
Yes.
Which we think makes the policymakers appear to be naive with their projections of inflation falling very quickly. So these are some graphs illustrating the data that they've analyzed. So it shows how quickly inflation tends to fall back after various periods of various rates of inflation. I think what you actually need to do is look at the graph and digest the content of it. And I would recommend you read the paper. It's very interesting.
I'd also add, Richard, that I've added these horizontal lines on the chart here.
Oh, yes. Yeah.
So you see that when inflation hits 4%, there's a 50% chance it will rise to 6%. When inflation rises to 6%, you see there's a more than 50% chance it'll rise to 8%. And when it rises to 8%, there's a more than 50% chance it'll rise to 10%. So the higher inflation gets, the more persistent it becomes.
Yeah. I mean, basically, the levels of inflation that we currently have in the UK, Europe, and America suggests that inflation is going to be very difficult to get back down to 3%, and it's going to take a long time. And I think everybody needs to bear that in mind in terms of managing their personal finances.
Mm. Yes, this is quite a difficult chart to interpret, I'd say. So if you're interested, please pause and take a look. So what it's saying is inflation above 8%, where peaking inflation at 8% takes on average 2 years to fall back to 4%.
And cresting inflation has been above, if cresting inflation has been above 8%, it takes 2 years before it falls back to below 3%. Again, I think read the paper if you're interested, because it gives a lot of the detail, and it takes you through the process of the analysis that they did.
Mm.
So, and our lesson is that inflationary episodes, when studied historically, are persistent, and peaking inflation takes a year to halve from 4 or 6%, 2 years to halve from 8%. Bearing in mind we have inflation significantly above 8%. But as we comment here, the Fed can force it back down. Central banks can force it back down if they raise interest rates much more rapidly and to a much greater extent. And that, of course, would have dire economic consequences in a different direction.
Essentially, this is in the hands of the Fed. If they are willing to drive the US economy into a deep enough recession, they can get inflation down quite quickly. It comes down to a political choice. Okay, on to recession watch. And tech companies having been pumped full of VC largesse, just hired way too many people and now starting to lay them off. And one thing that we are going to show you again and again is how growth forecasts are steadily declining. And this is German 2023 growth forecast. See, it's pretty much a straight line down, and there's no reason to expect that it's bottomed. In the US, house builder confidence and home buyer confidence is evaporating, and buyers are just disappearing from the market. And it was interesting to see the number of US housing starts and building permits was actually quite healthy. I mean, who's going to buy those homes? And if you look at year on year, this is sales, the number of sales transactions are just collapsing. Buyers are stepping away from the US housing market. Now, in the UK, we showed you earlier how the trade balance has actually improved. And the reason is that the non-energy balance has turned positive, which it only does when the UK consumer is doing really badly and not buying anything. And so that is not actually a very good sign. So the energy balance remains very negative, but the goods balance has actually turned positive. And this is global economic growth forecast for 2023. You see, there is just a steady decline everywhere. UK negative. There's no reason to expect this trend has stopped. So we've been saying this for a long time now, but the data is showing that we are headed for a global recession. Now, UK growth forecasts for 2023 been steadily downgraded, and the UK economy is now forecast to contract by 1.4%. I think that is way too optimistic. I expect that to be further downgraded. And on to the UK autumn statement. Okay, so this was yesterday, and these are our preliminary thoughts. Okay, so what happened? Well, the Chancellor, Jeremy Hunt, announced 30 billion of spending cuts, although most of those are going to be deferred until the 2024-2025 financial years, when presumably there'll be a different government. And there's also 25 billion of tax rises, taking the tax burden into the UK to 37.1% of GDP, which is a post-war record. The big announcements were a reduction in the threshold at which the 45% income tax band begins to bite, from 150k to 125k, a freeze on the thresholds for income tax and national insurance, a freeze in the inheritance tax threshold. No change, though, to the triple lock, so pensioners continue to be protected against inflation and the consequences of Brexit, which they voted for.
Immoral, in my view, forcing
Yes.
the younger generation to pay an inappropriate level of pension. I think it's appalling. David Cameron is a disgrace, and then should be ashamed of himself. Just appalling.
Absolutely. And basically, the Tory party rewarding its voters.
Yeah. Unacceptable.
Reduction in the dividend allowance from 2k to 1k, then £500. But a big thing for viewers of this podcast is that the oil and gas windfall tax increased again from 25% to 35% and was extended to 2028. The total tax on North Sea profits, according to Javier Blas of Reuters, is now 75%. And if the UK wants to improve its trade balance, it needs to incentivize North Sea oil production, and tax rates of 75% are not going to do that.
The problem we've got ourselves into as a society, we seem to be expecting that government is going to purchase services that it cannot afford to purchase. And then we complain when it doesn't as a society. And we need to really take a really good, long, hard look at what it is we wish to pay for and what we don't wish to pay for, in the context of the economic damage that these high tax rates will do.
Yeah.
I did notice yesterday also Jeremy Hunt, which I think is egregious. He said that it doesn't take our tax rates above any of the other G whatever 5, 7, 20 economies. Well, where are all those economies going?
Yeah.
The bloody tubes, excuse my language. So it's like, well, we're only going down the tubes as fast as everybody else. It's appalling.
Well, what I'd say, Richard, is that we like quality public services, but we've been unwilling to pay for them. And, not being willing to pay for them reveals our choices, Yeah. So either we have to accept poorer public services, or we need to stump up and actually pay for them properly.
You're quite right, Keith. And it's a choice that politicians don't make clear. And one of my gripes against our political system is the dishonesty of our politicians in terms of explaining what's really happening.
Yeah, I
don't think we can fix the system until they start to be honest. Fat chance of that.
I think you're going to be waiting for a long time. So we in the UK have chosen to elect the best liars who will tell us what we want to hear. Okay, so what has been the effect of the autumn statement? And this is a very sobering chart. Please pause and take a look. So back in March 2022, we were forecasting that in the 2026-2027 fiscal year, borrowing would be 31.6 billion. Since then, the forecast increase in debt spending and tax receipts, welfare spending has reduced that to almost 120 billion. And so the measures announced in the autumn statement only succeed in cutting our borrowing in 2026-27 to 80 billion. So despite the measures announced in the budget, we're still forecast to borrow a huge amount in 2026-27.
And that is assuming that interest rates don't go up and that tax receipts do go up because we haven't driven the economy into a deep recession.
Yes. So this is the forecast for UK GDP. And I struggle to see how the blue line, which was forecast back in March and in November, they have revised downwards.
Yes, that's a tricky one, Keith. I would agree.
Historic numbers. How does that work? But anyway, you're
These
now
are economists, Keith. They don't work like you and I do.
Yeah. Well, they're now forecasting this shallow recession that's going to last till 2025. Yeah, in their dreams, because the UK economy was already doing poorly prior to this coming recession. It's the only major economy that is still below its pre-pandemic levels. And as we've discussed, even after this autumn statement, the UK public sector debt is going to keep on rising. Back in March, the forecast was it would start to decline. Now, the forecast is it will continue to rise sharply. I mean, frankly, what Liz Truss was up to is just absolutely mystifying when you look at these numbers.
I know the more the numbers are analysed and brought out into the open, the less one understands what she and Kwasi Kwarteng were thinking of, because the numbers are dreadful.
Yeah, she is just absolutely delusional.
I do wonder whether they just didn't look at the numbers. They just thought this is their pet policy and they're going to do it anyway.
Yeah, actually, Richard, I think that's right.
Yeah.
So we've talked previously about how the debt interest expense has risen, and this breaks it down. And you'll see that we have a lot of RPI linked debt. And so because inflation's risen this year, we've seen a big rise in the costs of our index linked debt. But as they're forecasting that as inflation falls, so that will turn negative. But obviously, that is dependent on inflation falling back down. But because interest rates have risen, we've then seen big rises in the interest on conventional debt, but also, and something we've covered before, the Bank of England did QE, which bought loads of relatively low yielding long-term bonds and replaced them with short-term debt on which it pays interest. And now as interest rates are rising, the Bank of England has gone from sending money regularly to the Treasury to losing money on its debt portfolio. And so you see that the asset purchase reserves are now costing the country money. The effect of QE was to shift interest payments forwards in time from then to now. And so we are now paying the price of QE.
Which is a very good point, Keith, and it's also the same effect that borrowing has. And QE, of course, encourages government borrowing, and it simply shifts the repayment of that back to the future and reduces economic activity in the future to the benefit of economic activity now. The whole thing is simply a way of distorting the standard economic processes when you get to this sort of level of QE and minimum interest rates and so forth. Their behavior has been highly distortionary, and it sort of needs to come out in the wash. And if it comes out over the next 2 or 3 or 4 years, it's going to be very, very painful because there's so much of it to be rectified.
Well, this chart makes clear, Richard, your point earlier about how we are now paying for the pandemic stimulus, etc., etc.
Yeah.
Though, hopefully, if inflation comes down and the autumn statement has reassured markets, then hopefully the interest payments should peak and come down in the coming years. Now, one thing that I noticed was not mentioned in the budget, but the OBR stated in its post-budget statement was about the fuel duty. Now, you remember the fuel duty was cut by 5p back in 2022, and that's due to be unwound in March 2023. But the OBR were forecasting that fuel duty would rise by a total of 12p. I'm not quite sure why. Fuel duty has actually been frozen since 2011, I believe. And I think they're assuming that the rise will be reinstigated. So something to watch out for. Now,
all we need is an increase in the price of fuel, Keith, isn't it?
No, I agree, actually. The roads are really congested. And if we're actually going to be serious about the energy transition, then we should be raising fuel duty.
Yes.
Post the autumn statement by Jeremy Hunt, the OBR are forecasting that UK interest rates, will need to rise much less than they were forecasting in September after the Truss government's fiscal event. And that is good news. Although you notice that rates are still forecast to rise to 5%. And we previously talked about how loads of UK mortgage borrowers are on 2 and 5 year deals. And as their mortgages roll off and need to be refinanced, their mortgage payments will rise substantially. And now moving on to this chart, which is the forecast unemployment rate, and that's expected to rise towards 5%. But once again, that is dependent on a shallow recession of 1.4% of GDP. And I think that's way too optimistic. This, frankly, is possibly the most frightening chart in the deck. So the chart on the right shows real disposable income per person, and it's forecast to fall by the best part of 8% over the coming few years, taking us back to 2013-14 levels. And that is the biggest fall in real disposable income in the UK on record. And that, once again, is dependent on a shallow recession.
Unless you're a pensioner.
Yeah, exactly. Business investment is forecast to stagnate. And despite all that, the trade deficit is forecast to remain absolutely enormous.
I wonder if that's actually wrong, because if real disposable income drops so much, you have to start to wonder whether, as you said earlier, Keith, whether our imports will drop substantially. Yeah,
that's true. The good news is the OBR, like every other inflation forecaster, are forecasting that inflation will come right back down. And actually, they're forecasting that it will hit
0%.
Yeah.
I think if you're interested, if you look at the peak of the thick black line, I think that comes off exactly 90 degrees.
Richard, do you want a second job working for inflation forecasters? You have all the qualifications.
I have a protractor. I'll work in radians, so just to confuse everybody.
Yeah, you just need to underbid them by a fiver, they'll hire you.
By a degree, Keith, not a fiver.
Yes. So yeah, the OBR seem to be forecasting that actually UK CPI will go negative in 25-26.
I mean, I think it could do, but I don't think we're going to have that shallow dish-shaped recession if that's the case.
Yeah, no, I agree with you. Absolutely. So what is our view? Well, actually, I think the autumn statement strikes a decent balance of tax rises and spending cuts in order to stabilize government debt. But, we are still forecast to borrow a hell of a lot of money in 25-26. Its net effect, though, will be to cut government spending into recession, which will exacerbate the recession. And I fully expect us to undershoot forecasts of only a 1.4% contraction next year in UK GDP. And the net effect of all this, frankly, is that bondholders are being privileged at the cost of the rest of the economy. And that should be good for gilts and potentially good for sterling. Although sterling is also dependent on how the UK economy does. And if the budget actually exacerbates the recession, then sterling could still struggle. And you saw the trade deficit numbers. We remain very dependent on the largesse of foreign investors buying sterling assets.
Exactly. Yeah. Then moving on to the European energy crisis watch, we see that German power prices are remaining stable at that much lower level, albeit much higher than 24 months ago. They do appear to have stabilized. And the March forward German power prices are continuing to fall. They're still high, but they're continuing to fall. And March natural gas futures may have stopped falling at around about 3 times what they were a little over a year ago, about a year ago. We know that European gas storage is full, and so obviously there's a lot less pressure on the price of gas at the moment. And we're having our warmest November since records began. Although I don't think records began that long ago, did they? I think it's something like 30 years.
Yeah, 81.
81. No, 31 years. But obviously that's benefited the fuel situation by reducing heating requirements. And long-range forecasts are forecasting a warm winter. I don't know what they use for those long-range forecasts. Something to do with, I don't know, is it to do with, I don't know.
I don't know how they do it, no.
No. And this is showing that long-range forecasts for Upper Normandy are for a mild winter.
Yeah, I mean,
Normandy, it'll be warm-ish.
Yeah, these are really, very mild numbers.
They are, aren't they? Yeah, I don't know what the standard temperature is in Normandy for.
But, forecasting hardly any drop really from November.
Yeah. So the cold air is being trapped in the Arctic, apparently. And temperatures in the Arctic vortex are currently minus 84 degrees centigrade, which is 15 degrees centigrade last year. And one obvious point there is, I wonder whether the Arctic sea ice is going to expand significantly this year as a consequence of it. I don't know the answer to that question, but it'll be interesting to see if it does. And the overall mass of the cold air, because of course cold air is more massive, occupies the same volume, greater mass, 25 greater than last year. So when that moves south, we will have a bitterly cold period.
Yeah, we don't know where that cold air is going to move, because it can move in any direction. But when it does, but that could be bad.
And it's heavy, so it will be trying to force its way out of its constrained area. But I would like to know what's happening to the sea ice. Minus 84. Yeah. That's really interesting. So as we like to put it, the energy crisis has started well. I'm not sure if that's a sort of double negative, but because of the mild autumn weather. And current forecast for foliage is to continue. It has been very mild here in November, hasn't it? We know that. But we may be in for a very cold period later on. We don't know. So we're not out of the woods, I think is the point.
Yeah, so precisely. Thank you, Richard. Okay, quick update on the Chinese property market, because this week, China announced various stimulus measures, and Chinese property companies' shares shot up. Now, the Chinese property sector is absolutely enormous. estimates range from 2.4 trillion for the new home market to 52 trillion for the total value of Chinese real estate. And Chinese real estate accounts for around a quarter of domestic output and 40% of household assets. So 25% of GDP is in construction. But prices have been falling for a couple of years. And as you know, construction activity has been declining this year. Now, the IMF estimates that 45% of developers might not be able to cover their debt obligations, and 20% of them could become insolvent if there is decline in property prices. So the stimulus measures announced by the government really were, frankly, nowhere near sufficient to revive the falling property market.
So I think, Keith, the Chinese government is trying to tread a tightrope, isn't it, to deflate the property bubble at a rate that doesn't crash their economy.
Yeah. Well, lots of governments in history have tried the same, Richard, and they've generally been a failure because, you have these negative feedback loops.
Yeah.
As prices fall, everyone just waits for them to fall further. And no matter what the government does, you can't change those dynamics.
And effectively, you get a sort of discontinuity, which you can't smooth the discontinuity. You may be able to change where it happens, but you can't stop it from happening.
So anyway, hopefully you've had a chance to read that. So Chinese house prices have doubled over the last 15 years in nominal terms. But actually, when you adjust for inflation, it hasn't been too bad. So if the rise has been 25%. So unlike other property markets in the world, you can't say that house prices have been in a huge bubble. But the bubble has been in construction because Chinese households have a very limited range of savings options. So they've been buying lots of investment flats. And you see now that new home sales are negative. Newly started home construction is all falling. And prices have been falling for over a year now with no sign of reviving.
It is interesting, Keith, isn't it? If you look at the sort of area under the curve, sort of integrated by eye, the actual price drop that you see in 2022 is negligible in comparison to the area under the curve from 2018.
So, I mean, the rises over that period, yeah.
Yeah.
Now, this is a really important chart. So, 65% of the Chinese population now live in cities. And so, most of the construction work that needs to be done to accommodate people moving from the country into the city has already been done. And so the pace of construction now needs to slow and to fall by about 25% by 2030 in order to be consistent with future demand. And so we may already have seen the peak in Chinese residential construction. And that has big knock-on effects for commodity markets such as steel. You see that construction activity has stalled and is not recovering. So left-hand chart is floor space started. Right-hand chart is floor space sold. Industrial production also appears to have stalled. Latest figures is at 0% in October. Consumer spending is way off trend, very weak. Car sales, below trend. Real estate investment declining 15% year on year in October. And a fundamental problem for the Chinese construction sector is they start far more projects than they actually finish. So the red lines are housing starts. The blue lines are completions. So the whole of the Chinese construction industry has been reliant on this model where Chinese home buyers have to essentially pay for the houses while they're being constructed. And that has allowed home builders to start a lot more buildings than they actually finish. And how are those building projects that have been started going to be funded to completion?
Good point, Keith.
So in conclusion, the Chinese property market is a mess, and we can't really see a way it's not going to be fixed in to rebuild Chinese consumer confidence in the house building sector and stop house prices from falling further. So which has negative implications for Chinese GDP and also for construction related commodities. Richard, any comments?
No, I think you're absolutely right. We've been suggesting, haven't we, for a long time that the Chinese economy is going to be badly hit by this. And I think it will be. And I think there is an inconsistency between the Chinese economic data and what's happening in the housing sector or the construction sector. I think that, as we discussed, it's very, very difficult for the Chinese government to control this because it, as you rightly point out, a negative feedback loop. So it's just yet another significantly unstable element of the global economic situation. So moving on to some other charts. Paris is now Europe's largest stock market, having overtaken the UK, which is a bit dismal, isn't it?
Yep.
As an Anglophile.
Well, it's an inevitable consequence of Brexit, I'm afraid.
Yeah. So this chart says climate conferences have made zero difference to the rising global CO2 levels. And I don't think that's a surprise. And I don't think it's down to ill will on the part of anybody who attends these conferences. I think everybody wants to get CO2 emissions down. But you can't get your CO2 emissions down in the case of the West unless you wish to crash your economy, and in the case of China, unless you wish to stall your economic growth and have rebellion. And it's really, really difficult. And the way to do it is to take the hit, install a great deal of nuclear power, know it's going to take between 5 and 10 years to work, and at that point, expect to have a dramatic reduction in fossil fuel consumption. Now, that should have been done 25 years ago, but it wasn't. So it has to be done now.
Yeah. Well, after all that, we need a bit of good news.
There's good news, Keith. The good news is that aeroplanes float.
Well, remember this 13 years ago.
This is the Potomac, isn't it?
Yeah. So the this aircraft took off, was it from Boston, and flew into a flock of geese.
Yes, and it landed on and the pilot did a superb job of landing on the Potomac. And then there was a film, wasn't there, with Tom Hanks in it, which depicted that the pilot was vilified by the airline and they tried to blame him for the accident.
Yeah, it was a great film, actually. I recommend that.
Just extraordinary behavior by the airline.
Well, they lost an expensive plane.
Oh,
they could have lost an expensive plane and lots of passengers, but you know.
Could have, couldn't they? Yeah. Oh,
anyway, this week's good news is there's a solution, and it's quite cute. You've got a robo falcon. Yeah. This is great. So they fly this around the airport and scare off all the birds.
That is a very clever idea, Keith.
Yeah. So anyway, there's some good news of the week. Okay, on to equities. Richard.
Thanks, Keith. So it was a fairly, I think it was quite a volatile week for equities, but it was ultimately fairly benign. A little bit of a movement down for the FTSE and the stocks Europe, S&P and Nasdaq pretty much unchanged. Hang Seng up a chunky amount. I think Hong Kong has been rehabilitated in some sense recently, hasn't it? I think. Topic's down a bit. Bitcoin down a fair amount. Obviously, the FTX fallout still reverberating. If fallout can reverberate. and reasonable week for the pound and the euro. Dollar index down 0.8.
So this week I've added VIX at the bottom,
Yeah.
Richard, and all will be revealed in a second when we go through the charts. But
So Keith is mystifying me, having given me the chart to read. He's thrown in a curved ball at the bottom.
no, I have. Yeah, sorry. So
That's okay, no problem, Keith.
going forward, so when we go through the charts, you'll see the very successful strategy this year has been to buy the S&P 500 when the VIX is above 30 and sell it when the VIX is below 20. So hence, we've added VIX to the checklist.
Thank you. And here it is. And Keith has just explained it. And I think I'm going to, on a very small scale, we should give this a go, shouldn't we, Keith?
Yeah, I agree, actually.
We should just run it and see what happens. So where are we at the moment?
Well,
we're
VIX.
At 23. So basically, we're neutral. We have neither a buy signal or a sell signal at the moment.
Yeah, but it's drifting towards sell.
Yeah. And where do you get this chart from? Where did you pick the chart up from?
Charlie Bilello, who sends out a weekly newsletter containing a chart pack.
So what this is effectively doing, when the VIX goes up, effectively the markets are falling, and when the VIX falls, the markets are rising. So basically, the VIX goes above 30, the market has been falling and falling quite fast. So that's when you buy on the basis that it will revert. And likewise, the reason you sell is because it has stopped. The rate of rise is slowing, and it will likely to reverse again. So that's the principle behind it.
Yeah, and if you'd done that this year, you'd be up 25.6%.
No brainer, Keith.
Well, yeah. Retrospectively, it's a no-brainer.
So, at what point do you think it'll cease working?
The moment we start.
And the fear greed index is firmly in the greed. I mean, given that we're predicting that the world is heading towards a fairly deep recession, it's astonishing that the CNN fear and greed indicator is in greed.
I know, mystifying.
Yeah, totally. I mean, it's the opposite. Buy when blood's on the streets, isn't it? And sell when everybody's greedy. SoftBank Vision Fund has now lost more money since inception. I did notice. It's not funny, particularly if you're the gentleman concerned, that Masayoshi Son now owes SoftBank approximately $5 billion.
And this is personally, isn't it? It's absolutely amazing.
Yeah, $5,000 million. And I think, egregious greed, self-reinforcing bubble, it's just a symptom of where the governments and central banks have taken us over the last 10 or 15 years.
Yeah.
But there will be a massive buying opportunity at some point.
Yes, at some point, Richard. In the case of the Vision Fund, I think there's a long way to go.
Yes. Oh, yes. Yeah.
So this is US S&P margins. The blue line is forecast sales. The yellow line is forecast EPS. And so you see the two lines are diverging. And that means margins are forecast to collapse. Now, one thing we've covered many times on the weekly is how margins were extraordinarily high. And we said that that would mean revert. Yes, it will.
Yeah. Which suggests stock prices.
Yeah, exactly.
So the US outperforming the rest of the world since consistently, basically since 1989, and with a little bit of a dip in the 2000s. Yeah, I mean, how long can it continue to do so? And it's interesting, isn't it, that the last 20 odd years, FTSE's gone precisely nowhere, and in that period, the S&P has gone up. I don't know. Doubled, let's say, just roughly doubled. I think FTSE's gone there for 25 years probably. And the US, the US equity market remains overvalued. I just say, look at the chart of the S&P 500 or the Nasdaq, and you've got that spike up and a little tick down.
Yeah, I completely agree with you, Richard. But it's recovered over the last few weeks. This mystifies me.
Yeah.
We're heading into a recession.
And the dollar is unusually above fair value, according to Deutsche Bank, which suggests that the dollar index has some way to fall.
It does.
Looking at this, it has about, well, somewhere between 10 and 20% to fall.
Yeah. Now, you know that I am about 50% in dollars, so this is potentially bad news. The question is, but the reason the dollar's been rising is the US economy is doing well relative to everyone else, and the US is raising rates higher than everyone else. And both those continue to be true. So it's a question of, whether the US dollar keeps on rising in the short term. In the long term, yes, it probably should revert towards fair value. But in the short term, it could go anywhere.
And I think you're quite right, Keith. If you look at the last full up and down move, it started in 1995 and finished in 2009 over a 14-year period. So this process is not fast.
Yeah. On to commodities. This shows the base metals index compared to Chinese PPI. And you see there's a very good correlation between the two. Base metals essentially are one big China play. And earlier we were talking about how the Chinese economy is not doing well. And countries that have historically had huge property bubbles, like Japan, late 1990s, that can derail the economy for years, literally. So we're not forecasting a rapid recovery in the Chinese economy, and that means actually base metals could struggle for years.
I would pull copper out of that category and say I think that copper, and actually any of the metals that are significantly used in greening the world, so that include nickel, but steel, iron steel, tin, zinc, etc. Probably absolutely.
No, I completely agree with you, Richard. Green metals are exempt from that because we've got huge demand for the energy transition. But I suppose what we're really saying is steel.
Yes, agreed, Keith.
Okay, on to energy commodities. And oil had a very disappointing week despite continued drawdowns in oil inventories. So Brent was down 6%, WTI down 7.6%. European natural gas prices had a little bounce, up 7.5% for Dutch TTF prices. UK natural gas prices were flat. US natural gas prices were down. Coal bounced 3.1% and is up 97.5% on the year. But there are actually huge inventory draws in the US. The total crude inventories, including the SPR, were down 10.6 million barrels. Private sector inventories were down 6.5 million. So those are big draws. And you would expect that to support the oil price. But actually, the oil price was down quite heavily.
We also had the concept, don't we, that after the midterms, Biden was going to stop releasing oil from the SPR. Is there any sign of that happening yet?
No. US crude production was stable at 12.1 million barrels, up only 300,000 barrels on the year. The Baker Hughes rig count rose by 9. This is Brent. This chart shows you the forecast for US oil production. The light dotted line was the forecast from August this year, and it was forecast that it would rise substantially. And the dark line is now, and you'll see there's been a big drop in expected US oil production. So all the indications are that global oil supply is tight. It's disappointing. And so the outlook for the oil price really depends on demand. And we are forecasting a recession. How far will oil demand fall? Okay, so OPEC Plus met last month and announced that it was going to cut exports, and it has done. So these numbers are from HFI Research, and they're showing that over the last 2 months, OPEC Plus has cut production. And that's almost entirely due to the Saudis, who've cut exports by about 1 million barrels a day. So OPEC itself has cut exports, but they've been offset in part by rising exports of Russian crude. So OPEC Plus has cut less than OPEC. Now, I thought this was a really interesting chart. This is global oil inventories. Now, we've shown you, and we report in the weekly, US oil inventories, because that is the most easily accessible data. Total global inventories are painting a very different picture, and they're not showing continual declines in inventories. They're showing that actually inventories, they've been drifting off recently, but they've been pretty stable. And so they're portraying a global oil market that is actually pretty much in balance. And so hence, the oil price has not been rising continually, which is what you would expect if you just looked at the US oil inventories. Okay, Dutch natural gas futures stabilized. It's getting colder. Let's see what happens. And this is Qatari LNG capacity. And you'll see that over the next 5 years, they're going to massively ramp up production. Europe will be heavily dependent on LNG to replace Russian supplies, and there's lots of LNG. This is UK natural gas futures, stable. US, stable, heading into winter. I thought this was interesting. So the Permian, which is a big producer of natural gas, well, it has run out of export capacity, and that won't change until mid-2024. So if the US increases its LNG exports, that could really tighten the US natural gas market, which would be good for US natural gas prices. This is coal price coming off with natural gas prices, uranium flat.
Sorry, Keith, just popping back to natural gas. At some point, there's going to be a glut of natural gas and liquefied natural gas, and the price is going to plummet. But it's going to be a few years yet.
You can imagine, Richard, if there is a ceasefire, a change in regime in Russia, and Russian supplies were to come back on, then gas prices around the world would absolutely collapse. So, a lot depends on geopolitics at this point.
Yeah.
And forecasting is extraordinarily difficult, I'd say.
Yeah, and I was intrigued with the number of Qatari gas liquefaction plants coming online. And that's going to make a huge difference to the global supply. Qatar has vast gas fields. And of course, they couldn't get it out by a pipeline because they couldn't get it through Syria. But now they can go around Syria via the sea. And so at some point, there will be a glut of liquefied natural gas, I think.
And actually, very good point. Now, this week, I was going to do something on the capital cycle, and we will do it next week. But this is a really good example of the capital cycle. So gas prices have gone through the roof. Everyone's building LNG tankers, and they're investing loads in new LNG export facilities. And then, 5 years down the line, there's going to be too much of it.
Yeah, definitely. But quite interesting. So actually, if you do have any natural gas investments, just be Diversified Energy, which is one you and I both hold. Although I know they buy forward, but just be a little bit wary of what might happen to natural gas prices going into the next few years.
Yeah, I think you're looking at at most a 2-year time horizon for that investment.
Yeah, I think you might be right, Keith. So industrial commodities, quite a bouncy week, actually. If you just cast your eye down the schedule, some very small changes and some quite chunky changes. So aluminium, small change, copper, big drop, iron ore, big rise, and then a drop for nickel, and a massive rise for tin, and a decent sized rise for zinc. And I don't actually know whether there's any particular cause for those volatilities or whether it's just speculation. Any ideas, Keith?
Almost certainly speculation. I mean, the bounces in both iron and tin, you'll see that in the preceding periods, there have been big drops. And so presumably it's just speculators have been too short and been squeezed.
So we have aluminium. It is moving up, as you know, the aluminium production has been curtailed in Europe. And but obviously if Chinese demand is probably falling. There's cobalt. Copper, yes, a spike up and a spike down. Chromium. Iron ore. Lithium, stopped its little run up. Neodymium. Nickel, spike up and spike down. Tin has the spike up. Will it have a spike down?
Yeah, I think it will.
Yeah. Ferrovanadium, doing very little now. Zinc.
Again, spike up, spike down.
Yeah. So just running through the precious metals, quiet week for gold. Silver down 3%. Silver is very volatile generally. Platinum down nearly 7%. Whether that's related with car production and catalysts, I'm not sure. Rhodium up 2%. Palladium down 2.3%. So there's gold, which has had a decent run up, as we discussed last week. And maybe it's pausing. Personally, I hope it's pausing for breath. Or maybe it's going to go back down into that downward sloping trend. Gold price has held its value very well in Japanese yen, and it's nearly at its all-time high. Interestingly, if you like charting, that does look like a pennant formation at the top, and a breakout above 25,000 would see a significant rise.
I'll take your word for it, Richard.
Yeah, but don't place your money on it, Keith.
But I think the point is that, you know, we report gold in US dollars. Of course, the dollar has been strong. I mean, in every other currency, gold's been a great investment, frankly.
I think that's the point, isn't it? You have to look at it with the correct currency glasses.
Yeah.
So this is looking better than it has looked for a while. Platinum is making a decent run, actually. It's up about 20% in the year. Rhodium. Palladium.
Okay, thanks, Richard. Well, this week, rates continued to drift off. Now, as we get growing evidence that inflation may be peaking, then expectations of peak interest rates are also falling, and that is leading to falls in yields across the curve. So the UK 2-year actually rose by 7 basis points this week, but the rest of the curve all shifted down. And in the periphery of the Eurozone, we also had falls in the Greek 10-year and the Italian 10-year. So fears of an Italian and Greek default also seem to be fading. There was a speech earlier in the week by Silvana Tenreo, who is a member of the Bank of England's Monetary Policy Committee, who voted for only a 0.25% increase in October, which was obviously a lot less than what the Bank of England actually did. And she thinks that the UK rates may already have peaked. And presented in the dots are some upside and downside scenarios. And she thinks that rates will come down quite quickly as UK inflation falls, as the UK falls into recession.
So she might be right, Keith. It was a 0.75% increase on the 3rd of November that the Bank of England put through. I'm just minded of the dot plot chart that we showed at the start of this episode, where the dot plots were magnificently below the actual interest rates.
Yes, yeah, precisely. But also, the interest rate rise for the Bank of England were needed to reassure the markets that they were going to get inflation under control. Now, it may be the case that the weak UK economy would bring inflation under control anyway, but I think the Bank of England needed to signal to markets that it had firm intention of enforcing its mandate. So I think what she was suggesting was actually quite dangerous. If they'd only increased rates by 0.25%, it would have signaled entirely the wrong things to the markets.
Yes, I think you're right, Keith. Completely right. Yeah, it was important to get that signal out.
Yeah. One of the reasons that bond markets have been flying around all over the place is that liquidity in the treasury market has been terrible. And that is odd and in contrast to the size of the US treasury market, which keeps on rising. So you look at market depth on the left, it's very low when the amount of debt outstanding has been rapidly increasing. So that is not a very good combination. If you want to try and trade any of that vast amount of depth, then you're going to move the market. And that's why bond yields are flying around. And part of the reason for the lack of depth is that foreigners have essentially stopped buying treasuries. The purple bars are foreign transactions, foreign purchases of US debt. And you see, essentially, they have pretty much stopped. There's very little these days compared to what they used to be. And the US, having frozen Russia's reserves, has shown its willingness to use foreign holdings of US treasuries as part of its sanctions regime. So no wonder people like China are stopping buying US treasuries, knowing that if they ever fall out with the US will simply seize them. Okay, so this is UK 10-year. Is that a trend? Is it starting to come down? This is the UK 30-year, the same. US 10-year, too early to tell. German bunds. Italian 10-year. Now, I'm still expecting that Italy to have a very bad crisis. So let's just see what happens. This is Greek. So currently, stresses in the Eurozone are not getting worse, and the market remains confident in buying both Greek and Italian bonds. This is the seasonality chart, and in a bear market, and we're in a bear market, we should be now fading into year end. So concluding comments, well, the big news this week was the UK autumn statement, and we face a couple of very difficult years in which there will be a record decline in living standards. Richard, what did you get up to this week?
I had a pleasingly boring week in the sense that I didn't do anything. As we know, gold and silver both took a little bit of a knock during the week, particularly silver. And I was having had a good week last week. I was down 2% this week. So half of what I gained last week, I lost this week, which puts my change for the year at 4.2, my relative performance, plus 8.3. And I had no purchases, no sales. And I've just got one chart to show, which is, this is a Uranium Royalty Corporation. I am, as people know, keen on the uranium sector generally, and I do think that nuclear power is the way out of our climate mess that we've got ourselves into. And Uranium Royalty Corporation has been in this downward channel for a year now, and it's currently about half the price it was back in October 2021. And I have actually put a buy order in at 150, and I'm just going to sit and watch it. And I may change that up a little bit towards the 200 mark, but that's what I've done because I'd like to have some Uranium Royalty Corporation, but I'm not in any hurry to spend my money.
Very good.
How about you, Keith? How was your week?
Thank you, Richard. I had an okay week, up 0.6%. I'm having a good year. Okay, so I continued to buy duration this week. So I sold some of my short-term cash holdings, having made decent returns. Bearing in mind that I bought the short-term cash holdings in order to just get some interest on my bonds, on my cash, compared to the deposit account, and that's kind of worked. So I continue to buy the UK 2071 gilt and the 0.125% 2068 gilt, and that's got a lot of duration risk and is really, really volatile. I'll show you a chart in a second. And I also added to my US Treasury ETF.
Keith, can I just ask, what's your view on US Treasuries vis-a-vis the dollar index and the pound against the dollar?
I'm torn, Richard. I don't know. And so I've moved my holding to 50-50 a few weeks ago. And the thing is, the US is still raising rates, and the rates are going to rise higher than in the UK and elsewhere. But expectations for those rates have probably peaked. But the bottom line is that US yields are higher than in the UK.
Yeah.
So they've got further to fall. And therefore, so I'm just kind of mixing it. I'm not sure which of the two will do better. And obviously, as a UK taxpayer, UK gilts are exempt from CGT, which makes them a better bet. Mm-hmm. And over the course of the next couple of months, I will be moving more money into gilts than in US Treasuries. Okay, so the other thing that happened this week was the UK mini autumn statement announced further windfall taxes and, crucially, an extension in the period of the windfall tax to 2028. And that has been disastrous for oil companies exposed to the North Sea, such as Harbour Energy, Enquest, Serica Energy, which is mainly gas, and Ithaca Energy, which has been relisted recently, and it's been a disastrous start to its life back on the stock exchange. I mean, really, I know this is short-term political expedient, but it discourages investment in the North Sea and will have long-term consequences, in particular for our balance of payments, because there won't be a sufficient oil and gas from the North Sea to meet our demands.
I think from a political point of view, there's this contradiction, isn't there, which is we need to stop oil production because of pressure groups. We need to stop oil production because we have to limit carbon dioxide emissions. But at the same time, we can't limit carbon dioxide emissions without sensible, serious alternatives, which we don't have. Yeah. And so, in a sense, the government is going for the worst of both worlds: no sensible alternative and high taxes on a sector which is crucial to the UK economy.
Yeah, absolutely. And so this is the share price of BP, which has relatively little exposure to the North Sea, and so is largely exempt from the windfall tax. And you'll see that actually the share price has continued to rise. Reminder, I sold it back here. And that so far has proved to be the wrong decision. This is Shell. So frankly, one of the things that the autumn statement has done has been to make companies with exposure to the North Sea much less attractive. Now, there's obviously a price for everything, but I think actually the price of North Sea oil producers will have to fall a long way to make them attractive. So this is what I've been buying. This is the US Treasury 20-year plus ETF. And is that a bottom? We ask ourselves. I'm certainly hoping so. And this is the 2071 gilt. Now, these things are incredibly volatile. So I bought back in, but it's 65 I bought in. It bottomed below 50. Those are big falls. And so these assets are not for the faint-hearted.
Yeah, and I think it looks a relatively little blip on the chart, doesn't it, Keith? But if you had bought it in early September, you would have been down to, let's say, 45. You'd have been down the best part of 50%.
Yes, precisely.
So you have to be really, really careful. There is a potentially huge upside in due course.
Yes.
You have to be very, very careful about your entry.
Yeah. And if you do this, you get into these very long dated gilts. There's big potential upside, but the short-term mark-to-market losses could be enormous, and you need to be able to live with them. So in particular, I've been buying the 2068 index-linked gilt. Now, back at the beginning of this year, which seems a long time ago, the price of this instrument was over 300. It bottomed at 41 pounds. So that is an 85% decline. Now, it bottomed after Liz Truss's fiscal event, and it's since recovered. Now, is that a bottom? Now, I think that as we go into recession and interest rates fall, that we will go back to at least where we were in August, when the price of the 2068 index-linked gilt was around £1.60. And so you're talking about a 35-40% rise, tax-free. That's what I'm aiming for. But short term, could it go back to £1? And so you're talking about 15% decline? Absolutely, it could. So you have to be able to absorb those mark-to-market losses without panicking if you want to hold this gilt.
Yeah.
And
the other point, Keith, I think, is that you're looking at the time frame for the resolution of the interest rate conundrum is uncertain. In other words, it might happen in April. It might not happen until April 2024. But even if you have to hold for a 18-month or 2-year period, the projected gain it's worth holding for. But it is very, very difficult to understand when that might happen.
Yeah. And basically making big asset allocations on macro themes means it's very, very difficult to get the timing right. And you have to be able to sit through the losses confident in your long-term view. And that's kind of where I am now. But all that said, on the Discord, there's quite a lot of skepticism about this trade. And I don't want to be seen to be advocating taking positions, large positions like I've done in long-dated bonds without giving you the negative view of this trade. And there are very good reasons to be skeptical. So number one, as we discussed earlier, history has shown that when inflation is elevated, it tends to be persistent and to last for a long time. We showed you earlier that when inflation rises above 8%, historically, it's taken 2 years to come back below 3%. And low interest rates over the last decade were a function of extraordinarily low inflation and will not return. And therefore, you shouldn't expect the price of the 2068 gilt to go anywhere near the £330 that it was at the start of this year. And I'm not expecting that, but I am expecting it to go back towards 160 or £200. The other thing is that in order to get inflation in the US down, the Fed will need to raise rates to induce a recession. And there is a conflict there between its two mandates. It also has a full employment mandate. And as the US recession starts to bite, and so far it really has not done, so the Fed will come under increasing pressure not to raise rates as hard as it would normally intend to. And at that point, you could see inflation expectations start to rise again as the Fed doesn't raise rates as much as it should. And finally, fiscal balance. We have seen, despite the autumn statement, that UK public sector borrowing will remain very elevated. And so gilt issuance will remain high, and that may swamp demand, and that means yields could remain high. All of which adds up to very good reasons not to buy long bonds. But I believe in my predictions, and essentially I play the cycle. And so I think as we head into recession, so inflation will come down, and so long-dated bonds will do well as yields come down. And I'm making no predictions about the absolute levels of interest rates or yields. What I'm saying is they'll come down.
Very interesting, Keith. Thank you.
Okay, that's it. Very long one this week. Thank you for getting through to the end. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Weiser.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.